stop everything. Right now, as you're watching this, something is happening in the silver market that could expose the biggest financial fraud in history. And if you don't understand what's coming in the next 60 days, you could miss the wealth transfer of a lifetime, or worse, be holding worthless paper when the entire system collapses. I'm Robert, and I've been tracking commodity markets and stacking physical silver for 12 years. This week, I witnessed something that made me drop everything and record this emergency analysis. While mainstream media fills your screen with political theater and market rotation stories, there's a phantom event unfolding in the silver markets that should terrify anyone who understands how these systems actually work. Here's what happened this week that changed everything. Open interest on silver futures, that's the total number of active contracts in a market, has collapsed below 150,000 contracts. That's a multi-year low. In any normal market, when open interest evaporates like this, prices should be cratering. Basic supply and demand, right? Less demand equals lower prices. Except that's not what's happening. Silver is hovering just under $90 an ounce, fighting like there's an invisible floor underneath it. The spot price closed around $89.94 on the bid, $90.24 on the ask. CNBC called the morning dip a healthy correction. Bloomberg's headline said we're seeing rotation back into risk-on assets. They want you to believe the silver rally is over. But here's what they're not telling you. The screen is lying to you. The tickers say $89, but the physical reality, the actual metal you can hold in your hand, has left the building entirely. What we're watching isn't a market correction. What we're witnessing is a visible crack appearing in a ledger that was never supposed to be audited. But to see the crime, you have to look at the one place the banks can't manipulate. You have to look at the U.S. Mint's own storefront. Let me show you something that will blow your mind. The United States Mint, the government's official coin production facility, is selling their 2025 1-ounce silver proof coin for $173. Let me repeat that, $173 for 1 ounce of silver when the COMEX spot price is $89. Do this math with me right now. $173 divided by $89 equals a 92% premium over spot. The government's own mint is telling you that an ounce of silver is worth nearly double what the paper market claims it's worth. Now before the skeptics jump in, yes, this is a proof coin. Yes, proof coins carry numismatic premiums because of their collectible nature and limited mintage. But here's what matters. Historically, proof premiums have stayed in the 20 to 40% range above spot. Sometimes you'd see 50% for special editions. But 92%? That's not a numismatic premium. That's a replacement cost premium. The mint is telling you what it actually costs them to source raw silver blanks in today's market, regardless of what the COMEX ticker says. And that $83 gap between paper and physical? That's your first warning sign that something is catastrophically broken in the silver market. And what I'm about to show you next will prove that we're not just watching a market anomaly, we're watching the early stages of a Ponzi scheme collapse that could trigger the biggest wealth transfer in modern history. Stay with me, because the math I'm about to run will show you exactly when this could explode. Let me paint the picture of where we are right now. Silver is in what I call the battle zone, a slow bleed consolidation pattern where the metal is fighting for its life to hold $90. Every dip toward $89 gets bought. Every push toward $92 meets selling. This is a coiled spring under massive tension. But here's what's happening on the ground level, in the physical market. While the paper price is dropping, the actual acquisition cost for physical metal is hitting all-time highs. Premiums on standard bullion rounds from private mints are running $4 to $6 over spot. 2 years ago, those same rounds were trading at a $1.50 premium. American Silver Eagles, the most popular government bullion coin, are going for $7 to $10 over spot at major dealers when they're even available. Because here's the thing, availability is becoming the real issue. You can buy all the paper silver you want on the COMEX with a click of a button. You can own 10,000 ounces in your brokerage account instantly. But try to take delivery. Try to convert that paper into metal you can hold. See how fast that liquidity disappears. So why is the mint charging $173? Because they know something about the market that you don't. Let me explain the most important concept you need to understand about the silver market, and really, about any market where paper derivatives have massively outgrown the underlying physical asset. It's called paper-to-physical decoupling. Here's the technical definition. It's the systemic failure where the electronic claim on an asset loses all correlation with the actual cost of acquiring that tangible asset itself. But definitions don't help you understand the mechanism, so let me give you an analogy that makes this crystal clear. Imagine a movie theater with exactly 10 physical seats. The theater manager realizes he can make more money if he sells more than 10 tickets. So he prints 1,000 tickets and sells them all. Why not? As long as only 5 or 6 people actually show up to any showing, the system works perfectly. Everyone gets a seat, everyone's happy. The manager pockets revenue from 1,000 tickets while only maintaining 10 seats. The system looks liquid. It looks functional. People holding tickets believe they have a valid claim to a seat because they've got the ticket right there in their hand. But what happens when word gets out that this is actually a great movie? What happens when the 11th person shows up? Or the 20th? Or the 100th? Suddenly, the manager has a problem. He sold 1,000 tickets but only has 10 seats. People with tickets start demanding what they paid for. They want their seat. They don't care that the manager oversold. So what does he do? He has to bid any price to buy back those tickets before the crowd realizes there aren't enough seats. He has to make excuses about why the showing is delayed, why they should come back tomorrow, why they should accept a refund instead of actually watching the movie. And if enough people refuse the refund and demand their seat, the whole theater goes bankrupt overnight. This is the Ponzi. This is exactly what's happening in silver right now. And the math I'm about to show you proves that we're already past the point of no return. The numbers don't lie, and when you see what's coming in March 2026, you'll understand why smart money is quietly exiting the paper market right now. This next part is critical. The COMEX, the LBMA, the entire paper-silver market, they are that theater manager. They have sold far more claims on silver than they could ever possibly deliver if everyone showed up at once. Why does this matter now? Why is 2026 different? Because the U.S. Treasury needs physical silver for industrial applications, strategic reserves, defense contracts, solar panel mandates, electric vehicle initiatives, and all the green energy infrastructure they've been promising. But they also need the paper price suppressed. Why? Because silver is a barometer for dollar weakness. When silver runs, it signals to the world that faith in the dollar is eroding. It tells everyone that inflation is worse than official numbers claim. It undermines the entire strong dollar narrative that keeps foreign central banks buying our debt. So you get this impossible contradiction. The government needs physical metal while simultaneously suppressing the paper price. And the way they've been managing this contradiction is through leverage. In the futures market, most contracts are settled in cash, not physical metal. The buyer and seller agree to close out the position based on price difference, and nobody actually exchanges any silver. This is fine for speculators who don't actually want 10,000 ounces of metal showing up at their office. They just want the cash profit when they're right about the price move. But this system only works when the vast majority of contracts get settled in cash. Current estimates, and these are conservative, suggest that for every 1 ounce of physical silver in the registered vaults backing these contracts, there are between 50 to 100 ounces of paper claims. Think about that ratio: 100 tickets for every seat in the theater. This creates what's called a gamma squeeze potential. If even a small percentage of paper contract holders decide they want physical delivery instead of cash settlement, the entire system has to scramble to find metal that doesn't exist in their vaults. And when you're trying to buy something that doesn't exist, the price goes to infinity. The dealers who sold those contracts naked, meaning they sold promises to deliver silver they didn't actually have, face unlimited losses. They have to go into the physical market and buy at any price to fulfill their delivery obligations. Or they default. They declare force majeure, change the rules, and tell everyone, sorry, we can't deliver what we promised. Here's cash instead. We're not speculating about a squeeze anymore. The numbers are showing us that the audience is already heading for the doors. And when I show you the March delivery math, you'll see why this could trigger a gap up that makes GameStop look like a warm-up. Keep watching. Let me run the conservative scenario for you. Right now, open interest is sitting below 150,000 contracts. Each COMEX silver futures contract represents 5,000 ounces. That's the standard contract size. 150,000 contracts times 5,000 ounces equals 750 million ounces of paper silver. Now let's look at the actual physical silver available for delivery. The COMEX registered inventory, that's the silver actually available to be delivered against contracts, has been hovering around 30 to 40 million ounces. Let's be generous and say it's 50 million ounces. 750 million ounces of paper claims against 50 million ounces of physical metal. That's a 15-to-1 ratio, and that's being conservative. Now here's the stress test. March 2026 is a major delivery month for silver futures. Historically, the percentage of contracts that stand for delivery, meaning holders actually demand physical metal instead of rolling their position or settling in cash, runs around 2 to 5%. Let's use 5%. 5% of 150,000 contracts is 7,500 contracts. 7,500 contracts times 5,000 ounces equals 37.5 million ounces. The registered inventory is 50 million ounces. See the problem? If just 5% of current contract holders demand delivery in March, they'll drain 75% of the available registered inventory. And that's assuming nobody else tries to take delivery. That's assuming the registered inventory doesn't decrease between now and then, which it has been doing. That's assuming the bullion banks don't need any of that metal for their own industrial customers or government contracts. 1 delivery month. 5% standing for delivery. And the shelves are basically empty. Now let's talk about that $83 gap again. $173 at the mint, $90 at the COMEX. If the paper price were to catch up to the physical reality that the mint is already pricing in, we're not talking about a rally. We're talking about a gap up, a discontinuous price move where silver doesn't trade from $90 to $100 to $120 to $150. It just opens one day at $170 because that's where physical is actually trading and the paper market has to capitulate to reality. That's a 100% gain in a single session. But here's where it gets even more terrifying. There's a rumor circulating about a major sovereign buyer that could trigger this collapse within weeks. What I'm about to tell you hasn't been confirmed, but if even half of it is true, the silver market could be heading for a historic supply crisis. This is the information the mainstream media won't touch. I pulled up a chart comparing U.S. debt issuance to the silver price over the last 3 years, and the divergence is stunning. As government debt spirals higher, we're now adding $1 trillion to the debt every 100 days or so. Silver has started moving inverse to that debt. While treasuries are being issued at record pace, silver is acting like the exit door. It's behaving like the asset people buy when they've lost faith in the government's ability to manage its balance sheet. And here's the rumor that's been circulating in the private analyst community over the last month. I can't verify this completely, so take it with appropriate skepticism, but multiple sources have reported that China has been liquidating U.S. treasuries at a significant pace. The number being thrown around is $688 billion. Now, even if that number is inflated, even if it's half that, think about what happens if they redirect even 1% of that capital into physical silver. 1% of $688 billion is $6.88 billion. At $90 an ounce, that's 76 million ounces. That's 1.5 times the entire COMEX registered inventory from 1% of one potential buyer. The theater doesn't just run out of seats. The theater burns down. Wall Street knows this math. The big banks know this math. The Fed knows this math. That's why their counter-arguments are becoming increasingly desperate. Let me address the skeptics directly, because there are 2 main arguments against the decoupling thesis worth examining. First, the $173 price is for a proof coin. It's a collectible. You can't compare it to spot price. This is actually the strongest point against my argument, and I want to give it proper respect. It's absolutely true that proof coins carry premiums above their melt value. They're struck multiple times with specially polished dies, they have mirror-like finishes, they come in presentation cases with certificates of authenticity. People collect them. But here's what matters: the historical range of those premiums. I've been tracking mint pricing for over a decade. Proof silver eagles have typically carried premiums of 20 to 40% over spot. In special years, low mintage years, anniversary editions, first strikes of new designs, you might see 50%. During the peak of COVID supply chain disruptions in 2020 and 2021, we saw premiums stretch to 60% or even 70% for brief periods. But 92%? That's not numismatic value. That's not collector demand. That's the mint pricing in replacement cost. That's them saying, we cannot source the silver blanks we need to make these coins at anywhere near the COMEX spot price, so we're going to charge what it actually costs us to produce them. A 92% premium is an outlier data point screaming at us to pay attention. Now here's the second argument skeptics make, and when you understand why they're completely wrong about this, you'll see why collapsing open interest is actually the most bullish signal in the entire market. This completely flips conventional wisdom on its head. Second skeptic argument: low open interest means interest in silver is dying. People are leaving the market. That's bearish, not bullish. On the surface, this makes sense. Open interest represents the total number of outstanding futures contracts. When it drops, conventional wisdom says that means less participation, less demand, bearish sentiment. But you have to understand what open interest actually represents. It's not just buyers, it's buyers and sellers. Every contract has two sides, someone who's long, someone who's short. When open interest drops dramatically, it means contracts are being closed, positions are being unwound. But why? In a normal market decline, you'd expect open interest to drop as speculators give up and exit their long positions. The price would fall as they sell. But that's not what we're seeing. Open interest is cratering, but the price is holding firm around $90 with a floor underneath it that seems artificial. Here's my interpretation. In a true Ponzi collapse, the smart money exits first. The people who understand the system, who know where the bodies are buried, they get out before the crowd. But in the paper silver market, who are the smart players? The bullion banks themselves. The market makers. The very institutions that sold those naked contracts in the first place. If you're a bullion bank and you sold 10,000 contracts naked, betting that only 200 would ever stand for delivery, and suddenly you're hearing rumors that China's buying physical, that industrial demand is spiking, that retail stackers are emptying dealer inventory, what do? You close your position. You buy back those contracts before delivery month arrives, and you're on the hook for metal you don't have. That reduces open interest. So low open interest isn't a sign that interest in silver is dying. It's a sign that the counterparties who are providing the selling pressure have left the building. Nobody wants to be the one holding a short contract they can't fulfill. If the theater manager realizes word is getting out about his ticket scam, what does he do? He stops selling tickets. He might even buy some back at a small loss to reduce his exposure before the crowd arrives. The market goes quiet. Open interest drops. But the underlying tension, the gap between promises made and metal available, that's growing, not shrinking. So what happens when this situation starts to unravel? There are specific warning signs you need to watch for, and some of them are so blatant, they'll make you question everything you thought you knew about free markets. I'm going to show you exactly what to look for. When this starts to break down, there are specific signs you need to watch for. The first thing I'm looking for is an emergency margin hike. The exchanges, the COMEX, the CME, they set margin requirements for futures contracts. That's the amount of capital you need to hold a position. When volatility increases or when the exchange perceives systemic risk, they can raise those margin requirements on very short notice. The stated reason is always to ensure market integrity or to protect against excessive volatility. The real reason is to force the little guy out of his position before the big move happens. If silver starts to gap higher, if it breaks above $100 with force, watch for an announcement from the CME that they're raising silver futures margin requirements by 50% or 100% effective immediately. This forces smaller speculators and retail traders to either put up more cash or close their positions. It's a way of shaking the tree before the fruit ripens. The second indicator is a media blackout or technical difficulties on major pricing sites. I know this sounds conspiratorial, but I watched it happen in real time during the nickel squeeze on the London Metal Exchange in 2022. When nickel went from $20,000 per ton to over $100,000 per ton in a matter of hours because a Chinese metals giant got caught in a massive short squeeze, what happened? The LME halted trading. They canceled trades that had already been executed. They changed the rules mid-game to protect the short sellers. And during that chaos, multiple pricing websites and data feeds mysteriously went dark. Technical difficulties. Unexpected server issues. If silver gaps above $100 and holds, watch how responsive the pricing data is. Watch if Kitco or Bloomberg or major futures platforms suddenly have issues with their feeds. I'm not saying this will definitely happen. I'm saying it's a pattern we've seen before when a market breaks outside the controlled range. Let me give you the specific indicators I'm watching on a day-to-day basis. Indicator 1. Force majeure declarations from small miners. Force majeure is a legal clause that allows a company to break a contract because of extraordinary circumstances beyond their control. If you start seeing small to mid-sized silver miners announce they can't fulfill their forward delivery contracts because of unforeseen circumstances or operational challenges, that's a canary in the coal mine. It means they sold their future production forward at $80 or $90, and now the physical market is demanding $120 or $150, and they're losing money on every ounce they deliver. They'd rather declare force majeure and pay the penalty than honor the contract. Indicator 2. The gold-to-silver ratio. Right now, with gold around $45,970 and silver at $90, the ratio is about 51:1. That means it takes 51 ounces of silver to buy 1 ounce of gold. Historically, that ratio has averaged around 65:70:1. During periods of extreme silver strength, it can collapse to 40:1 or even 30:1. If you see the ratio start to collapse rapidly, if silver starts outperforming gold on a percentage basis day after day, that's the market telling you that industrial and monetary demand for silver is overwhelming the paper suppression. A move toward 40:1 would suggest silver is in the early stages of a genuine supply crisis. Indicator 3. Shadow flows from sovereign buyers. This is harder to track because sovereign accumulation isn't always reported transparently, but there are indicators. Watch for reports from the South China Morning Post or other Asian financial media about Chinese state-owned enterprises increasing their strategic metals reserves. Watch for any announcements from Russia or other sanctioned nations about adding silver to their reserve mix as a dollar alternative. These buyers don't care about the COMEX spot price. They're buying tonnage. They're taking physical delivery. They're removing supply from the global pool permanently. If even one major sovereign announces a significant silver accumulation program, the available physical inventory evaporates overnight. And here's what keeps me up at night. What I'm about to tell you is the darkest possibility in this entire scenario. When the banks can't deliver, they won't just accept defeat. They'll do something that will shock the world. But first, let me show you my exact battle plan for navigating this minefield. If the banks can't find the metal to deliver against their contracts, they will change the rules. They'll declare force majeure. They'll settle in cash at a fair market price they determine. They'll suspend trading. They'll do whatever it takes to avoid bankruptcy, because that's what entities do when facing an existential crisis. They don't accept failure. They rewrite the rules. Which brings me to my personal plan for navigating this minefield. I'm going to be very transparent about what I'm watching and what my trigger points are. I'm not doing this to tell you what to do with your money. I'm not a financial advisor. I'm sharing my process so you can see how someone with 12 years of experience in this market is thinking about the current setup. First and foremost, I'm not making moves based on emotions. I'm not FOMOing into silver at $90 just because I think it's going higher. I'm not panic selling because I'm worried about a correction. I'm watching the $90 support level like a hawk. Here's my framework. Trigger A. If silver closes a weekly candle below $90 with conviction, and by that I mean a weekly close at $88 or lower, I expect a test of the $75 to $80 value zone. That would represent roughly a 15 to 20% correction from current levels. It would shake out the weak hands, the over-leveraged futures traders, the people who bought the hype without understanding the fundamentals. Would that invalidate the decoupling thesis? No. It would just mean the paper market still has enough control to engineer one more shakeout before the physical reality takes over. If we get that move, I'm a buyer. I'm looking to add to my physical stack in the $82 to $85 range. Trigger B. If I see a spike in intent to deliver notices on the COMEX for the March contract while the price remains stagnant or even declines, that's my signal that the decoupling is entering the crisis phase. Intent to deliver notices are filed by contract holders signaling they want physical settlement, not cash. The exchange publishes this data, though it's usually delayed a few days. If those notices start coming in at levels significantly above the historical 2 to 5%, that's the equivalent of the movie theater crowd all showing up at once. At that point, I don't care what the spot price says. The physical market is about to decouple violently from the paper price, and I want to make sure I'm holding metal, not contracts. Trigger C. If the U.S. Mint maintains these $170 plus prices on their proof coins while spot stays suppressed below $100, I'm sitting on my hands regarding government coins. That 92% premium is insane. I don't care how collectible the coin is, I'm not paying double the spot price just to get a government-issued product. Instead, I would pivot to private mint bars or secondary market rounds. I'd be looking at 10-ounce bars from reputable private mints like Sunshine, Asahi, or Geiger. I'd be checking the secondary market on sites like PMS for Sale on Reddit, where stackers sell to each other. The goal is to acquire ounces, not to pay premiums that may never be recovered. Now let's talk about what I'm doing right now, today. I currently hold a significant physical position in silver that I've been building since 2015. My average cost is somewhere in the $18 to $22 range. So even at $90, I'm sitting on substantial unrealized gains. I'm not selling. Here's why. The decoupling thesis isn't about price, it's about availability. We're entering a period where the question isn't, what's silver worth? The question is, can you even get silver at any price? If the COMEX defaults, if major dealers suspend sales, if sovereign buyers corner the market, the people holding physical metal are going to be in a very different position than people holding paper contracts expecting they can just buy later. So I'm treating my physical stack as a strategic hold. It's not trading capital. It's wealth preservation and optionality for a world where the paper markets have lost credibility. That said, I'm keeping some dry powder on the sidelines. If we get that dip to $82 to $85, I'm deploying 20 to 30% of my remaining cash into additional physical. I'm not going all in because I want to maintain optionality, but I'm absolutely buying that dip if we get it. And if we don't get it, if silver just grinds higher from here without giving us a better entry, then I'm comfortable with my current position. I'm not chasing. I'm not buying at $100 or $110 or $120 unless I see the decoupling accelerate and I believe we're in the early innings of a true supply crisis. One more thing, I'm avoiding the sovereign premium trap. What I mean is I'm not paying current mint premiums for proof coins or even for standard American Silver Eagles if they're running $8 to $10 over spot. The premium you pay going in is the premium you have to recover coming out. If you buy a Silver Eagle today at $98 and spot is at $90, you need spot to hit $98 just to break even on that premium. Generic rounds from private mints are trading at $4 to $6 over spot. That's a much more reasonable entry point for someone looking to maximize ounces per dollar. The only exception I'd make is if you're buying for long-term wealth preservation and you specifically want the government recognition and liquidity of American Eagles. There's an argument that when you go to sell, especially in a crisis, government coins have better liquidity and recognition than private mint rounds. I get that argument, I just don't think the current premium spread justifies it. So here's the bottom line, and this is the part that should make your blood run cold. We're not watching a normal market anymore. We're watching the final act of a Ponzi scheme that's been running for decades. And the window to position yourself is closing faster than most people realize. Let me bring this all together. The screen says $90. The U.S. Mint says $173. The COMEX registered inventory is historically tight. Open interest is collapsing. Intent to deliver season is approaching. The Ponzi, that is, the U.S. Treasury debt system, is being exposed by a metal they can't print. This isn't conspiracy theory. This is math. This is observable market data. This is the gap between what the paper system claims exists and what the physical market is pricing in. We are entering a period where price matters less than availability. You're going to see headlines over the next few months calling this a bubble. You're going to see analysts on CNBC telling you to take profits, that silver has run too far too fast, that the fundamentals don't support these levels. Don't let the ticker gaslight you into thinking the system is stable. The system is stable until it's not. Markets remain irrational until they can't. And Ponzi schemes work perfectly until the day they don't. The sovereign buyers know this. The industrial users know this. The bullion banks know this. That's why the smart money is exiting the paper system quietly. That's why open interest is dropping while price holds. That's why the mint is pricing in replacement cost instead of spot. The silent exit has begun. The only question is whether you're going to be holding metal when the music stops or whether you're going to be holding a paper claim on a promise that can't be kept. I've been in this market for 12 years, and I've never seen conditions like this. The math is simply too loud to ignore. If you found this analysis valuable, make sure you're subscribed to What Happened After because this situation is developing rapidly. I'll be posting updates as we approach the March delivery period and tracking every indicator I mentioned today. Hit that notification bell so you don't miss critical updates that could impact your positioning. Drop a comment below and let me know, are you holding physical silver or are you still in paper? What's your strategy for the next 60 days? I read every comment and I'm curious to hear how you're thinking about this setup. The window to position at these prices is closing. The math is screaming. And the silent exit has already begun. The question is, will you be ready when the theater runs out of seats? This is Robert from What Happened After. Stay sharp, stay informed, and I'll see you in the next analysis.